On this episode, we're going to talk about passive income strategies for physicians using self-directed IRAs. Coming up next on this episode of Bootstrap MD. Never use dogs as props. Hey guys, this is Dr. Mike Wiming with Bootstrap MD. Hope you guys are doing well. And we just finished the Boot Camp MD about a few weeks ago, and one of my speakers, faculty members, is here today, Travis Tollestrup. Let me tell you about Travis. So Travis we've known each other for a few years, but we were recently on a cruise ship, on the ClickFunnels 2 Common Club cruise ship, both entrepreneurs. And we actually found out we live here in San Diego County here, and he is really the expert when it comes to passive income through real estate. And we were having an event, and not a lot of doctors, as you know, knew much about it. So I said, we need to get this out to the group. Let's get you out on the podcast. Travis is the managing director of Capstone Funding Group. It's a San Diego-based real estate and investment group. And he's been creating passive income for his investors for over 17 years, with many of them medical doctors. So, Travis, thanks for coming on to the podcast.
Hey, great to be here. I appreciate you making time and inviting me on. I've got some good stuff to share here.
So let's just kind of talk about it. We're fresh off, the Physician Entrepreneur Workshop that we put out here in San Diego, and you did like a little impromptu poll. You want to talk about that?
I do. My first exposure to self-directed IRA investing was back at the beginning of 2003, and I was a young married, getting going, very interested in real estate. Had read a book, Rich Dad Poor Dad, sparked some interest. And
Kiyosaki, yeah.
As a newlywed, I didn't have a whole lot of money and didn't have a whole lot of credit, and so I was, open to learn more about that. But at that time, I was introduced to the concept of building your own private bank. Okay. And it was the founder of a company called Equity Trust Company put on this boot camp, and I went and learned all about what we call self-directed IRA investing. And at that time, during this event, he talked a lot about physicians and the opportunity that is there. And so I immediately went home from this boot camp wanting to implement, had several good deals that we were working on and needed some funding. Found out as I started to do a poll that about 1 in 10 knew what it was, period. They, so there was an awareness gap, right? Just that they didn't know. And come to find out, fast forward 16, almost 16 years, because we're in 2019 now. We're at the Boot Camp MD event, right. And I just, at the beginning of my presentation, as we were talking a little bit about self-directed IRA investing, how many of you guys have actually heard of that? And with the 20 plus doctors in attendance, one doctor raised their hand.
And it wasn't me.
So think about that just for a minute. It kind of blew my mind, to be honest with you, with the onset of the internet and, this education and opportunities to be educated that it's not out there. It's right. What I call the best kept secret, in terms of growing your retirement bucket tax free or tax deferred, depending on how you set it up.
Yeah, it's one of the things, that we struggle with as physicians is we don't get any in terms of financial education on that. And oftentimes we have to rely on a financial investor that maybe we found on Yelp or something, or was our uncle's friend or something like that, right, that referred. Yep. So one of the things the reason why I put out things like the podcast is to help us with education, because I'm all about passive income, but not only for myself, I'm naive in a lot of these vehicles that we start putting our money in and letting our money work for us than rather against us. So we're here to talk about self-directed IRA investing, but let's first talk about what are the different types of self-directed retirement accounts.
Okay, great. Well, the basics that are I would say the most common is you've got a traditional IRA. Okay. Right, and that's open to everybody. And that is a tax-deferred investment vehicle. So meaning you get a tax deduction for putting the money in that offsets your gross income. And then the other very common one is the Roth IRA. And these are at the personal level for someone who doesn't necessarily own a business, which we'll talk about that in just a second. But the difference between those two, on the Roth IRA, you don't get a tax deduction going in, but the growth is tax-free forever. Mm-hmm. So let me just repeat that. Tax-free forever. So I always ask the question, would you rather pay tax on the seed or the harvest? Right? And so that's when you talk, and sometimes in certain cases, doctors, because of their, if they file a joint return with their spouse or even on their own, they make too much money to get set up with the Roth account. Right. So, with a personal consultation, we can kind of help them see what the other options are, but just passing through. So those are the two individual ones. Mm-hmm. Then moving to the business level, you've got a SEP IRA, which some doctors have. Some doctors, because of the need to include employees, have a simple
So these are
IRA. These are physician-based plans.
These are self-employed physicians.
Yep, self-employed physicians. And if you're able to set up what's called a solo 401k through your practice, where that includes just you and your spouse. A lot of times based on employees, there's testing where they've got to be able to, they can't, quote, discriminate against their employees. So they have to include them, which really limits what type of plan they can have. But that's a topic it's a very in-depth topic for another time that we can talk about.
Sure.
But if you're able to set that up, what's really neat about that is it also has a Roth component to it, which can allow for kind of a dual bucket where you can have some growing tax deferred and some growing tax free. So we just kind of assess to see if that's something that's,
is that also
that's
limited by their income though?
That is not, because it's in their business.
Gotcha.
So, and you can actually, what's neat about the solo 401k is you can soak away. I have to just confirm this last tax year. It kind of changes year to year. But at one point, it was up to $55,000 that could be soaked away, based on your 401k salary deferral, and then the actual employer contribution, which you're the employee and you're the employer in a closely held entity yourself. So, but yeah, again, just on that account, we could spend a 60-minute webinar with a full set of slides going through the intricacies of that, which maybe in the future we can do that. Yeah.
So you mentioned something that, we were talking before this podcast about the self-directed custodian. What is that? What is that all about?
Well, these accounts are set up. Congress is the one that, these originated because it was an account they wanted for themselves, right? So any changes in these are actually, it's done at the Congress level, right? But a custodian, now you're going to hear the word a self-directed custodian, but you'll also hear about a TPA or a third-party administrator. Mm-hmm. And what's the difference? Well, a self-directed, really it comes down to regulation and reporting in terms of, the IRS and these regulatory bodies. So a self-directed custodian is usually a trust company or a bank. And they have a trust charter with the state. And again, we could go deeper on this, but just know that if you were to ask which is better, the higher regulated, one that has the rules of a bank and a trust company, they follow a little bit more stringent guidelines than maybe a third-party administrator. And there may be a third-party administrator that listens to this and might have exception to that. But they would also admit that at some point as they grow their company big enough, they would like to apply for a charter, a trust charter with the state and become a trust company themselves. So it's key when you're looking for that. Just make sure you look for an entity that is, when you're custodian, that they are a trust company or a bank.
So just to kind of reiterate, we got these different accounts that we can do. Tell us about the types of investments that we could be putting into these type of accounts.
Okay, great. So you hear about these alternative off Wall Street opportunities that are available. I say you hear about them, but actually we don't, because we know that one in 20 heard about it. But so really the real question is, because it's so expansive and so broad on what you're able to invest in, it's probably best to say what you're not available to invest in, because that's a very short list. And then the rest of it is pretty much wide open. But life insurance contracts are not allowed. Okay. Collectibles are not allowed. and shares of an S corporation are not allowed to be invested. Just imagine that your retirement account is a separate entity from you, right? And we'll get into a few rules here in just a minute, but that is, if you remember that, that's key. And then you just say, so really it's wide open. You can buy a piece of property. You could make a loan, which is one of the most common, which again, we're going to get to, but it's pretty much wide open. So if you just remember, can't buy life insurance contracts in there.
Right.
No collectibles.
I can't put a life insurance against my employees. Can't do that.
No. And collectibles, you can't buy that. And then just shares of an S corp. But, real quick, just to make a point, we won't talk a lot about it, but you heard about, there's one of the founders or one of the main stockholders in Facebook invested in those early shares of Facebook in his Roth IRA.
Oh, wow. You
heard about it back in the election when Mitt Romney was running. People say, how does he get a $100 million IRA? Yeah. It's not through contributions. It's through what he invested in initially in those, so-called penny valued shares at the time that they started. And then obviously
that's with Bain
Capital.
With
Bain Capital, with the growth of those entities, it was within that IRA structure. And when it grew, there you go. Okay. So, and here's the thing. This same vehicle is available to the general public. It's just they don't know about it.
Gotcha. As in anything, you need to keep yourself educated about this. So tell us what investments we can't do. What are the most common type of investments that you see in your experience?
Well, and again, we work a lot in the real estate field, and that would expose my bias, about that. But the reality of it is that these real estate secured loans, where the account holder is able to be very passive, but yet their investment is secured to the actual piece of real estate, that is very common, very common. And maybe just real quick on that, people, because I get these questions a lot, people are like, well, if I have the money in the IRA account and I take it out to make a loan against real estate, isn't that like an early withdrawal penalty? Right. Don't I get like an early tax penalty on that? And now it all becomes taxable income. And it's like, and so I spend the time just to describe that you instruct or direct your self-directed custodian to make that investment. And what happens is the investment, whether it's a piece of property, whether it's a loan secured by real estate, whether it's a private stock in a company, they actually make that investment and it's registered in the name of your IRA account. So it'd be X custodian for the benefit of, and then it would have your, Mike Wu Ming IRA or Mike Wu Ming SEP IRA, whatever it is, and it never leaves, right? Gotcha. So it never leaves. So it stays within. Exactly. So there's no early withdrawal. There's no taxable event because it's within that, and it maintains that tax deferred or tax-free growth depending on how it's structured. So just an important little point to remember there, because that is one of the most commonly asked questions that we get once they do find an investment, or an asset class that they want to invest in. They're like, there's a block. Like, well, I can't go do this because I'll be taking the money out. And I'm like, no, the money doesn't come out. It's always, and so that gatekeeper, that custodian is the gatekeeper with the IRS of movements in and out of the account and or the nature of the investments within the account.
So let's talk about, with the self-directed IRA, what are kind of the rules we need to be aware of, we need to follow?
Well, the biggest rule, there's lots of different rules. Yeah. Definitely, like I said, we can, talk about this again and go deeper on some of these rules. But the main one to remember, and it's, IRC 4975. So it's the Internal Revenue Code 4975, and it deals with related parties and prohibited transactions. So if you just remember, what's prohibited would be, obviously you can't transact business with yourself. So your IRA account could not do business with yourself, right? And then it's kind of a lineal husband-wife. Then it goes up, mom and dad, or parents or in-laws, down to kids, grandkids. So it's like that all, we're a family member. They're considered what's called, quote, a related party, and that constitutes a prohibited transaction. What's the penalty? That would result in a being fully distributed, that account, taxable penalties. They basically unravel the account due to that prohibited transaction. So you want to stay away from that. And what's interesting, when you think of that lineal descent, or that line, if you go up and down, but now what is allowed, what is not considered a related party, which is very intriguing to me, go right to left. So brother or sister are not considered related parties.
Okay.
So it's very odd.
That's interesting.
Very odd, but it is functional. So any questions on that, though, I'm happy to answer, because they're usually, when people are trying to structure a different investment a certain way, you just want to make sure that you do it correctly. And we've done a lot of different things. So happy to have people just, bounce that off of us and make sure that they're, not in the gray area, but it's,
What are some things that, as I guess you work with a lot of doctors, what are kind of the most common questions you get about this that we haven't covered so far?
I would say one of the most common one is, it comes around the tax, how do you maintain the tax advantage structure, right? They're very concerned about making a wrong move. Yeah. There's a lot of questions that come around that. The other questions relate to just the security of the investment. So then it kind of moves away from the actual, investment shell or the IRA itself, and it moves more into the actual investment opportunities and what they can do and how they're structured. So that those are other questions. But those are really, I would say, really the top two.
Big ones.
Those are the top two. And, because once they find out about it, they're like, wow. And then it's, how much am I allowed to put into these accounts on an annual basis? And then that becomes a matter of finding out what you qualify for, whether it's at the personal level or at the business level. And, like we just talked about earlier, some of these accounts, have the ability to soak away a lot more. And again, it just depends what you're needing at the time. Tax deductions now for high income. And if you plan on being in a lower tax bracket at retirement, some people say that, I'd rather take the tax deduction going in versus coming out. But, I say if you're going to, this is just personal opinion, but if you're going to be in a lower tax bracket when you retire, then your advisor wasn't doing everything they should have. You would want to be at least in the same one, right? I mean, there's different things you can do structurally, but you want to be in a situation where you're walking out of, from one income stream and walking into retirement and enjoying the same level of income, So yes, it might end up where you might be in a lower tax bracket. So some of that planning does affect the accounts that are used up front, how they're structured, how they're set up. So, everyone's situation is a little bit different, but that's kind of a generalized rule of thumb.
That's awesome. So, just in the last remaining minutes, anything else you want to share to our audience?
People have asked what resources do you have that we can get up to speed, understand more, kind of go in depth on this, because they really want to get serious about growing these tax advantage accounts. And, a good friend of mine, Matt Sorensen with KKOS Lawyers, wrote the book called the Self-Directed IRA Handbook. Okay. And we've had him speak at a couple of our events over the last couple of years, and very highly rated speaker, goes through it in depth, but that is a great resource. And then obviously just,
that's like on Amazon or...
Yep. They can go get that. It's available. And then, just in upcoming content, where we look to be able to show how an actual transaction is done, from the custodian level all the way to taking it through from A to Z. Those are things, if that's of interest, would love to be able to share that and show a few case studies into the future as we talk more about it.
Okay, awesome. So my audience are physicians. Many of them own their own business. Where can they go and get some more information on self-directed IRAs? From you?
The number one thing that they need to understand is that there is a custodian. They at some point will need to choose a custodian. So if they were to Google self-directed IRA custodian, there'll be a list, right? And I'd be happy. We've done business with probably the top 10, so, and as you can imagine, the experience varies, right? And there's different from customer service to, because when you need to make an investment, a lot of times there's time frames involved. And so if it takes them time to process paperwork, get it done, there's just a lot of factors that go into choosing your custodian. But so I would definitely start getting a feel for the custodian, and then just questions in general and investment strategy, right? Because the mainstream media, the Wall Street side of things, they want, stocks, bonds, and mutual funds, assets moving outside of their control. They're not going to be too friendly towards that. So we've found that a registered investment advisor that's literally acting in the best interest of the client understands these types of opportunities and is actually very proactive in recommending them to their clients. But that's not always the case. Anyway, but yeah, so happy to answer any questions on that. My email is just travis@capstonefundinggroup.com. And then, if anyone gets in touch with you or just, forward them on. A lot of what we do is by referral, so we appreciate those as they come in.
And your website is?
Yep, capstonefundinggroup.com.
Okay, and they can get more information about this in depth and about your company as well. And just if they, there's an opportunity to schedule a call, we've got blocks of time where if they just have specific questions as it relates to these, they've heard about it, but they're like, I just need to talk to someone. I've got a few burning questions that I just need to get answered, what they might have heard elsewhere and want to fine tune it. We'd be happy to help them. This has been awesome. Again, I needed to know more about this. That's why I had Travis here. He's really the expert on this. It's all about building passive income. And that's, we work hard as doctors. We want to make sure that, the income that we bring in, that, we get to keep. This is, we pay our taxes, but we also want to make sure that the money that we're using is also, being well spent, for us and for our family. So thanks again for joining us on the Bootstrap MD podcast. And as always, guys, keep moving forward.